it has been for 2 years as ICHAM organizing a series of webinars that trying to bring the most insightful and the most important knowledge and information, update information towards the business community and towards what we can provide to the business community. And we also are trying to bring in the top key speaker of the different industry and different experts. So in order to help you to have the most update and insightful information. So today we were talking about one of the most important and get the let's say the most attention of the enterprises, which is tax and transfer pricing regulation in Vietnam. And we are very happy to bring you today two very high-level speakers. The first one is Ms. Bùi Kim Ngân, the Tax Director of Grant Thornton, Vietnam. And the second one is Mr. Hoàng Việt Dũng, the Tax Transfer Pricing Director of Grant Thornton, Vietnam. About Grant Thornton, I believe there's no need to further introduction because the reputation of Grant Thornton globally is already well known from many companies in different industry. And today, Ms. Bùi Kim Ngân, the Tax Director of Grant Thornton Vietnam, will share with us about the tax expense, the tax benefits, labor issue during the COVID time, local tax audit, and note for preparation, because you already know that this COVID time, this COVID-19 has been creating a lot of problem for the business world for the last 2 years. And also the company are struggling about finding to survive, but also to maintain the duty of tax towards the local authority. And what should we do about this for the tax expense and tax benefit during this period? So Ms. Bùi Kim Ngân will help us to understand about that. And for the second part of the webinar, Mr. Hoàng Việt Dũng, the Tax and Transfer Pricing Director of Grant Thornton Vietnam, will help us to understand about the key transfer pricing and tax-related compliance matter for FDI company in Vietnam, the transfer pricing and tax audit trend in the new normal. We're very looking forward to be open again. In Hanoi, maybe next week, and in Ho Chi Minh City from maybe by the end of September. And after the presentation of Mr. Dũng, we will have the Q&A session. During the presentation, if you have any question, please feel free to raise your question in the chat box, and our staff will help you to refer directly to the speaker in the Q&A section. And now, not to take you any longer, I would like to leave the floor to Ms. Bùi Kim Ngân, the Tax Director of Grant Thornton Vietnam, for her presentation. So Ms. Ngân, please.
Yeah, thank you, anh Hải. Yeah, please wait a minute. I will share my slide. Okay. Hello everyone, my name is Bùi Kim Ngân. I'm Tax Director at Grant Thornton Vietnam. I actually have nearly 15 years working in professional consulting and advisory service on taxation already. My specialization are tax planning, tax health check, due diligence, licensing service, and compliance procedures for FDI company. So first of all, I would like to say thank you to Italian Chamber and Mr. Hart, who gave us this opportunity to share some information about some recent tax and labor policy on. So the contents of my presentation will be divided into two parts. The first part is the policy on tax and labor during COVID-19 periods, which you may have known that COVID-19 have taken a great effect to all of us, and we will see how tax and labor policy have been changed to adapt with this pandemic. The second part of my presentation will be the tax audit procedures and how to prepare for it. And So come to the first the topic, the policies on tax and labor during COVID-19 period. As you may know, the current COVID-19 customs in Vietnam are still complicated, and Vietnam's government are trying hard to manage it with some method which have quite bad impact to the business. And as you still remember, the COVID-19 period, the COVID-19 lockdown period has been started in Ho Chi Minh starting from early of July, and in Hanoi by the end of July, and it's lasting now, and it has taken the great impact to the business. So first of all, I want to have the small survey to you all to see how the COVID-19 had the impact to you. So could you have to answer the poll question within 20 seconds? What is the impact of COVID-19 on your enterprise? The first one is reduction in revenue. Second one is difficulty in finding new clients and expanding the businesses. The third one is difficulty in securing materials resources for production. Fourth one is production capacity is due to social distancing or lockdown requirement. The fifth one is shortage in business cash flow. The sixth one is increasing in expense during the COVID-19 prevention requirement from state agency. Next one is no significant impact on COVID-19 on revenue or expense, or your business have significant increase on revenue from high demand due to COVID-19. Yeah, could you please have to answer the question so that we could have a view on the impact of COVID-19 on your business. You could select more than one answer. Okay, so we got the result now. I noted that more than 70 answers, the 70% inform us that there will be a reduction in revenue, and 62% saying that they will difficulty in finding new clients and expanding the businesses. 23% got the difficulty in securing raw material resources for production. 38% saying that production capacity is reduced due to social distancing or lockdown. 40% finding the shortage in business cash flow. 39% increasing expense. 60% no significant impact, and 3% got the significant increase in revenue. So the enterprise who got significant increase in revenue is very lucky comparison with other, right? I see that many impact of COVID-19 to your business, and most of them is negative impact. So Vietnam's government had many policy to support the enterprise as well as labor during that hard time. And in next by presentation, I will go into details on some policy which have been applied or will be applied by Vietnam's authority to minimize the impact of COVID-19 to your business. The first one, I will talk about the guidance on the some deductible expense related to the COVID-19. As you may know, Vietnam's government got the vaccine fund established by the government with the target of getting the donation from the enterprise as well as individual to with the main target is providing the free vaccine to all of the people with in Vietnam, whether it's a local or expatriate. You could also get the free vaccine, right? So many enterprises had the concern that whether if you spend some money sending to that fund, so it could be deductible or not, because that kind of expense is not clearly noted in the current regulation of the corporate income tax. So that is why the government had issued the decree 44 in this year 2021, saying that the sponsoring expense for COVID-19 prevention activities will be treated as the deductible expense of enterprise. For the others kind of expense, such as the supporting expense for employee to labor who got the suspension in labor contract, or the quarantine expense at the hotel for the local or expatriate who come back to Vietnam and need to stay at the hotel during that period, or effect cost to come back to Vietnam during COVID-19 period. All of those expense will be treated as the deductible expense, as according to the recent guidance by the General Department Taxation. Other kinds of expense could also be deductible for the calculation of corporate income tax. Will be the testing COVID-19 expense, or the salaries for expatriate working without work permit during quarantine period, or salary for employee during social distancing or job waiting period. For COVID-19 expense, I believe that many of your companies have paid that expense quite regularly, because as a requirement by the authority, the manufacturing company want to operate normally, they will need to prepare, they need to perform the testing for at least 20% of worker every week, right? So the testing COVID expense will be very, could be quite high expense for the enterprise recently. And according to the guidance by GDT, we understand that all of those expense will be deductible for CT calculation purpose. For salary for expatriate without work permit during after quarantine periods. So as you might remember that at the very early stage of the COVID-19, there will be one guidance by Ministry of Labor, Invalids and Social Affairs, Molisa, that the expatriate who come from the country who got the COVID-19 pandemic will not be granted or will be delayed granted work permit. So many of our clients got the difficulty in obtaining work permit by that time. And some of them still need to pay the salary for expatriate who are working in Vietnam, right? But could not get the work permit. According to the previous regulation of tax authority, the expatriate who are working in Vietnam without the work permit, will, so the salary for those people will not be treated as the deductible expense. But due to the guidance by Molisa, the Buckling Tax Authority had issued the official letter No. 2099, informing that for the expatriate had been delayed of granting the work permit due to the guidance by Molisa. The salary for those people still be calculated at the deductible expense. And we noted that for during this period, there were many label. Many employees have lost their job or have no income, having no income or no salary due to the job waiting or social distancing. So some enterprise have provides some support for the employee, which means that even they did not work for the enterprise, but they still pay some kind of basic salary or some minimum salary for the employee, even they did not work for enterprise, as one kind of support for those people. So they're concerning that whether those salary will be treated as the deductible expense or not, because it's not support for the business activity, right? But it had to keep the label to stay with the enterprise to resume the operation in the future. So according to the guidance by Hanoi Tax Authority and General Tax Department, we understand that all of the expense will be treated as the deductible expense. Some expense which the enterprise we have paid for the employee, which you might have the concern whether it will be treated as the benefit of the employee and it will be calculate PAT or not. So we will be go through one by one. The first one is the quarantine expense at the hotel. As you might know that for the employee who go, for example, for business trip or for home leave to overseas and then come back to Vietnam, they will have the quarantine period for about 40 days or 21 days. And normally this will be performed at the one hotel, one permitted hotel in Vietnam. So they were concerning that whether the hotel expense during quarantine periods will be treated as the benefit of the employee and will we calculate the PAT on that or not. The answer from General Department of Taxation is yes, you will calculate it as the taxable income from employee. But how we treated that is as a taxable income. So in the detailed guidance by the local tax department and like Hải Phòng Tax Department or Bắc Ninh Tax Department, they guide for Hải Phòng, they treated that the hotel expense during the quarantine period, which the company paid on behalf of the employee, and those expense have been clearly noted in the labor contract that the employer had the obligation to pay for housing allowance of that employee. In that case, the hotel expense for quarantine period will be treated as a taxable income, but will be treated as a housing allowance. So that kind of expense will be calculated as a taxable income, but not exceeding 15% of the total taxable income, excluding housing allowance or hotel expense. And in case the company had to pay two kinds of housing allowance. The first one is the accommodation fee for the some house you already rent for your employee in Vietnam. And the second one is the hotel expense during the quarantine period. You need to pay both, right? So according to the guidance by the Bắc Ninh Tax Authority, the house which you rent for the employee and they did not stay on that hotel because they go outside Vietnam or they stay in the quarantine area, right? In that case, the house rental expense will not be included in the taxable income, but the hotel expense for quarantine period will be treated as the taxable income. So there were two kind of expense, right? House rental, no tax. hotel fee taxable, but not exceed 15%. So they treat it as a housing allowance. Yeah, for the other kinds of expense, other kinds of benefit which employee have got, for example, the company could provide some mask or antiseptic liquid or protective gear for employee. So whether it will be treated as the benefit of employee and included in the taxable income or not. According to the guidance official letter no 6297 by Hanoi Tax Authority, though expense will not be included in the taxable income of the employee, so they will not be subject to PAT. In the same guidance, Hanoi Tax Authority also saying that expense for COVID testing will not be treated as the benefit of employee and will not be calculated PAT. Same as the quarantine cost for this trip. In case you could prove that the quarantine expense incurred during this trip of the employee. So though the expense is compliant with the company policy for business trip, in that case, the quarantine expense will not be added to the taxable income of employee. So for the first two kinds of expense, like expense for mask, antiseptic liquid, or COVID testing or protective gear, we understand that because though expense is provided for the massive for all the employee in the company, and we could not divide the specific benefit, specific amount which each employee would get benefit from that. That's why the tax authority permitted to not include in the PAT of each employee. For quarantine costs, we understand that in the concept, in case you got the business trip, it's for the business purpose of company, right? The employee could not get any benefit from that. So why the employee need to pay the tax on that? That's the concept why tax authority confirm that in case it's comply with the company policy on the business trip, it will not be added to the taxable income of employee. That's some new guidance on treatment of the CAT and PAT. Next part, I will talk about the tax deferral policy of the government have just issued within this year. Most of you already know about the decree 52 have just been issued this year, right? On the delaying in tax payment. So for the enterprise in most of the economics area will be granted the deferral on tax payment. For VAT, it could be last the defer for the VAT payment up to 5 months, and for the period from March to June 2021, or first or second quarter of 2021, and for July, there will be deferral 4 months. August, deferral of 3 months, and for CAT, for the in first and second quarter of 2021, there will be 3 months of deferral in payment. For land rental, with 6 months of deferral. Actually, all of the deferrals will be due date by the end of this year. It means that the state budget for the whole year is still get the same amount, but there will be some delay in payment of several months only. Actually, it will have the very good impact to the cash flow of the company. For the company who had the shortage in cash flow, there will be the great support for that employee. But in case you got the cash flow, but you have a very high expense which you have not yet been covered, you could not cover for it. So is there any other policy to support you? Actually, at the moment, Ministry of Finance already proposed to the government on the tax deduction in this year. As you might remember, last year, according to decrease 142 last year, the company might already got the 30% of city payable deduction for last year 2020, right? But this year, the proposal from Ministry of Finance will be not only with the city. They also request for the reduction in the PAT as well. MOF only proposed a 50% of PAT deduction for the last 2 quarters of 2021 for business household and individual. 30% of VAT reduction for enterprise and organization operating in certain service sectors such as tourism and traveling and some manufacturing area. And MOF also proposed for exemption from late payment interest rising in 2021 and 2022 for enterprise incur the loss during the 3 year 2018, 2019 and 2020 due to COVID-19 pandemic. So this support, I think, will be quite much higher than last year, because this year more and more companies got the bad impact from COVID-19 and need more support to maintain the operation and come back with the market. So we are waiting for the official approval from the government on this proposal. That's some tax policy which support the employer and employee. So next I will come to some labor policy which provide support to enterprise, employer and employee. As you might have heard about resolution 68 and decision 23 of the government. In this decision, you will know some policy which support for the enterprise, such as the reduction in insurance premiums for occupational accident and disease from 1.50 to 0 for 1 year period. Kindly be noted that even the enterprise do not need to pay this amount to the government, but this amount should be treated as the benefit to your employee and should support directly to employee to support on COVID-19 prevention. For example, you could purchase some masks or more protective gear and provide to your employee. It's also one kind of direct support. Or you treat the whole amount, so 0.5% as the allowance to your employee and pay directly in cash. Is also one kind of support. So please be note that you should keep track of this fund and ensure that it has been granted to your employee. One of the support from government to enterprise, suspension of contribution of retirement and survivorship fund is one fund in social insurance fund, and the suspension period could last for 6 months. In case you got some employee got suspension in labor contract, or they could not go to work due to quarantine, so you could apply for suspension of contribution to this fund for about 6 months. Enterprise also could apply for the loan to pay the wages for employee during the suspension periods or paying for salary for production during the production recovery period. So how much you could get the loan? The loan could be equal to 3 months salary. This salary here is only the minimum, regional minimum salary of your employee, and maximum period to get the loan is 3 months, and you will need to pay back the loan within 12 months, and you will get the loan at bank of social policy. For employee, in this decision, there was quite much policy to support the employee. In case you got the employee which on the temporary suspension employment contract or unpaid leave, which means they do not have any income during this period. So the suspension or unpaid leave period less than 15 days and more than 15 days and less than 30 days. So that employee could get around 1.7 million Vietnam dong. And in case the suspension period more than 30 days, they could get 3.7 million Vietnam dong. For the policy for employees subject to quarantine or in lockdown area, they could get the support from government up to 1 million per person, and this one is this support is one-off payment only. And in case you got the employee who need to terminate the employment contract, but because they do not contribute unemployment insurance for 12 months in advance, so they could not get the unemployment allowance. In this case, they could apply for this supporting policy. They could get up to 3.7 million per person in case they have been terminated the employment contract. Besides from this, in case your enterprise need to change the operation or technical to adapt with the new situation, and you need to retrain your employee with the new system, so you could apply for the support from the government up to 1.5 million per employee need to be retrained. But of course, you will need to get the supporting document for that, proving that you actually have spent the money to train for your staff. One of the other support policies, this one is newly issued. Recently, we understand that Malaysia Ministry of Labour, Evaluate and Social Affairs have approved the proposal from Vietnam Trade Union on the reduction of health insurance contribution for 8-month period from June 2021 to January 2022. So your enterprise as well and your employee do not have to contribute the health insurance of 4.5% of health insurance anymore during this period. There will application subject for this. And one of the support from Vietnam Trade Union on the meal allowance, they will support for the employees and nutritionists of trade union of the enterprise implementing the 3 on-spot working regime. What is 3 on-spot working regime? Which means that the employee needs to stay at the company and perform the production and staying that for the whole period, and then they could switch to the other group of employees, so to ensure the COVID-19 prevention. So in that case, you could apply for the meal allowance up to 1 million per person, and this support is paying on up only. This decision from Vietnam Trade Union will take effect from 24 August 2021. So maybe most of your employees have not yet implemented this policy. That's all I want to share with the recent guidance of the authority to support on tax and labor matter. So next, I will change a new topic of the audit procedure, which most of you will want to hear about, because most of your employees have the tax audit, right? So, please be note that even the timeline for my presentation is also about half hour. But as discussed with the Italian Chamber, I want to extend my presentation to ensure you got the more information during this period. So please prepare for that. And before I go to this topic, I want to know about the tax audit the practice in your company and in this time. So I want to get a small survey on this topic. So could you show the pool? Which kind of tax or custom audit that you or enterprise have been dealing with during COVID-19 period? It means that during the period 2020 and 2021, you have been through the tax audit for own kind tax or transfer pricing tax audit or corporate income tax audit or personal income tax audit or custom audit or no tax or custom audit yet. Yeah, you will got 20 seconds to answer. You could select more than one answer. So with the result, I noted that 50% of the answer is saying that no custom audit or no tax or custom audit yet. 24% of tax audit for own cap tax. 15% saying that there will be transfer pricing tax audit. 25% have corporate tax in corporate income tax audit. 19% of personal income tax audit. So you based on this result, I observed that there will be quite minimum numbers of the tax audit have been performed during the COVID period, and with the tax authority will focus on CAT, corporate income tax audit, PAT, personal income tax audit, and transfer pricing tax audit. So be limited in the number of custom audit. Okay, thank you. So here is the results of the tax and inspection, tax audit and tax inspection in fiscal year 2020. As informing by the General Department of Taxation, the tax authority already carry out more than 30 or nearly 84 tax audit or tax inspection at the taxpayer headquarters, and I have checked around 500,000 tax dossiers at the tax authority. This one we call it the tax audit at the tax office, the desktop tax audit, and the total tax revenue increase to the state budget is 29 billions of Vietnam dollars, nearly 20 billions of Vietnam dollars. Deduction of 2,000 billion Vietnam dollars in comparison with the last year, which means 2019, the period without COVID. So there will be a reduction in state budget income, and reducing in loss of 49 billion Vietnam dong of the taxpayer. The total amount of tax paid to the state budget is 12 billions Vietnam dong. Tax debt decreased by 5.5% same period last year. Total collectible debt to total revenue is at 4.4%. So with this number, what we could learn from it is mean that the number tax audit decrease, the number, the state budget revenue is decreased, the tax debt increase, the tax paid to state budget decrease, tax debt decrease. So the business in the business as the business of own enterprise is not really good, right, during the COVID-19 period. So what will be the tax audit plan in fiscal year 2021? There will be estimation of the National Assembly's of state budget revenue this year will be more than 1 billion Vietnam dong. Please be note that this is on for the whole country. For the whole state budget is not only the revenue from tax, it's also revenue from the other areas as well, like custom, like oils and gas, like that. There will be 5% of the target of the total tax debt. The 5% is the target of total tax debt for this fiscal year, which means that the outstanding balance of the tax debt by the end of the year will not exceed 5%. And the policy for the tax inspection plan and tax audit plan this year will be strengthened the management of collection, prevention loss of revenue, speed up collection of tax area, speed up inspection, control tax declaration and payment, management tax fund, develop, implement tax inspection plan, and while implement prevention of revenue loss on non-state enterprise and business household. So some results have been achieved during the first 6 months. Is 32,000 inspections have been carried out, exceed the same period last year of 10%, and the total amount handling is 22,000 billions. Actually, this quite positive number of the first 6 months, right? But in fact, the fourth wave of COVID-19 in Vietnam it goes around May, and the last 6 months of the last 6 months, most of the us had get the very bad impact from it, especially in Hanoi and Ho Chi Minh, due to some very strict lockdown policy. So as our information, this year Hanoi Tax Authority intend to carry out the tax audit and tax inspection at the enterprise with the around 2.5 thousand enterprise will be subject to the tax audit by Hanoi Tax Authority, and to 1.2 thousand the tax audit will be carried out by Hanoi Tax Authority, but most of them had not yet been performed. So we believe that after the lockdown, the tax audit in both Hanoi and Ho Chi Minh will speed up the process, and some key topic they will focus on will be the transfer pricing tax audit in some area like e-commerce, hospital, and some finance area. Yeah, that will be the key topic from the tax authority in the remaining time of the year. So do you know how many types of tax audit? Actually, we usually know the tax audit on the taxpayer headquarters, or tax audit by the custom authority at the headquarters office, right? But in fact, there will be one kind of tax audit which you have not yet been known, is the tax audit at the tax authority office. How we perform it? We call it the desktop tax audit. How will they perform it? They will collect information which have been submitted by the taxpayer and then as the taxpayer come to the tax office to explain on their concern, which during their reviewing the tax return or final statement of the taxpayer, and if you could explain clearly their concern, so there will be mean that there will no tax audit at your office at all. No tax. So that's why you might have the concern that why so many. So we have operated for so many years, but no tax audit aside, because maybe your accountant already come to the tax authority and explain to them the concern over the accounting document. So they will not perform the tax audit at your office anymore. This is the tax audit procedure implemented by the tax authority. The first step normally it will be implemented by the first quarter of the year. The tax authority will prepare the audit plan for the year. They will develop the plan, approve and adjust the plan. Normally it will be finished by 31st of March. And then with some case of unexpected audit, like they detecting the organization or individual showing sign of tax violation, tax law violation, they got the complaint on the tax obligation, or your company had the split, merge, or consolidation require the tax audit, or they got the tax inspection, or they need to inspect the taxpayer at the request of the higher level, such as the GDT or MOF. After they got the plan at the first quarter of the year, they will perform audit at the taxpayer office. So you will have a concern that, so whether they will got the tax audit during the first quarter of the year. Actually, yes, they do the tax audit in the first quarter of the year, but most of them will focus on the tax audit like liquidation case or tax audit on the PAT. They will focus on the first quarter, and the next quarter after fixed plan, they will perform tax audit to inspect all type tax or focus on some topics. The procedure to audit at the taxpayer office will be, first they prepare and issue the audit decision, and then they conduct the tax audit, and by the end of tax audit, they will issue the report and audit conclusion and publicize the audit result, which means informing the taxpayer. And after finalize the tax audit, they will input in the data system and report to the higher tax authority. Kindly be noted that the result of your tax audit will be input in the system called TTR, and by the result of that tax audit, they will rate your company as a compliant and non-compliant, high risk or low risk of tax, and that database will be used to determine whether in the future you will be subject to tax audit or not. So we try to minimize the tax heavy pays in the tax audit minute, right? For tax inspection, did you verify the difference between the tax audit and tax inspection? Actually, the tax audit, the tax inspection, the procedure is almost the same, but the tax inspection will cover the border area. Time will take longer than tax audit, and of course the result will be more complicated and take more time consuming. Detailed procedures, detailed case of tax audit and tax inspection will be like this. For a tax audit, in case you fail to explain or supplement the document dossier required as a tax authority, you will subject to tax audit aside, which means that at the tax audit, desktop tax audit, you fail to provide the explanation to tax authority, you will subject to be tax audit at your side. Tax audit also carried out in cases of legal violation, or they will be checked before the tax refund. If you want to get the tax refund, of course, they will tax audit. Case selected according to the annual plan and topic, or case of division or separation, merge, consolidation, and other case. So most of your tax audit will be will belong to type 4. Case are selected according to the annual plan and annual topic. So how the tax authority will select your company to the tax audit, how they select the company in the annual tax plan and annual topic. The tax authority has the system called the tax risk assessment system. In this system, the tax authority will rate each taxpayer in some area. In case the taxpayer have some sign of tax risk, they will rate you with the very high risk, and you will be more regular to be subject to tax audit. In case you got the low risk, you will be less time to be selected for tax audit. For example, for the annual plan, they so which kind of the risk the tax will determine is high risk or low risk. Some area the tax authority will consider as high risk as this. If you are the company, manufacturing company, but you do not have the fixed asset or very low level fixed assets, that will be determined at the high risk. Or you have the very low capital contribution, will be high risk. It's thin capitalization. Or in case you change your headquarters regularly, change the location regularly, it will be high risk. Or in case you got the significant increase or decrease in revenue, it will be considered as high risk. So based on that, the tax authority have the criteria to rate each of the taxpayer, and based on that, the result they will select on annual plan. So how they select for the annual topic? Actually, by the beginning of the year, tax authority will have the meeting to discuss on the which is the hot topic during the last year, and they will determine which area is a very high risk area. For example, transfer pricing, e-commerce, or for example, this year they select the transfer pricing, e-commerce, or hospital, because that is a area which had the very high impact by the COVID-19, and they select that area is a high risk area. So in case your business is belong to that area, it's likely that you will be high chance to get the tax audit. Similarly, the tax inspection also been selected based on the annual plan, or the tax inspector could based on the side breaking the law or resolve the complaint report, or as requested by MOF. Also, there will be tax inspection. The procedures of one tax audit on one tax inspection will be like this. First, the tax authority will issue the decision of tax audit or tax inspection and send to taxpayer. And after sending to taxpayer, they will need to come to the taxpayer to announce the decision. So these procedures could take around 10 days for tax audit, or 15 days or 15 working days for tax inspection, 10 working days for tax audit. And after announce the decision, they will perform the field work at the taxpayer side. And these procedures for tax audit will not more than 10 days. And plus, in case they need the extension, it will extend for up to 10 working days and more. So the total of the working time of the tax authority aside for tax audit is only 20 working days. And for the tax inspection, in case it's conducted by General Department Taxation, the total timeline could up to 70 days, which means the 40 days is the normal, and the 20 in cases there will be many cases of difficulty that will extend by 25 days, 25 working days. And in case the tax inspection performed by local tax authority, it could up to 45 days, 45 working days. After field work, the tax authority will issue the tax audit or tax inspection minute. It will be no more than 5 working days upon completion of the field work. And as the enterprise to sign on the tax audit minute within 5 working days of the issuing of the tax audit minute. So in case you do not agree with the tax audit minute, whether you need to sign on the tax audit minute, the answer is yes. You still need to sign on the tax audit minute within 5 working days from the receipt date of the tax audit minute. But you could clearly note your opinion on the tax audit minute that you disagree with the opinion of the tax authority and send back to the tax authority. Please be note that in case you do not sign on the tax audit minute, you will violation the regulation. After the minute has been signed, the tax authority will issue the decision on penalty on or tax violation decision. And this period could last up to 7 working days. And in case it's complicated case, it could last for, could be extended by 23 days. So the total timeline to issue this decision no more than 30 days. Same as the tax inspection. And for the tax inspection, there will be one procedure of the conclusion of tax inspection. This procedure will last about 15 days from issuing a tax decision on tax administration. And after complete, that's the total timeline for the one tax audit or tax inspection. So with this regulation, you could see that the tax audit will not last for 3 months. And the tax inspection also will not last for 6 months. So what else? What if you, after the tax audit, you tax audit or tax inspection, you disagree with the opinion of the enterprise? Because as I explained before, even you do not agree, you still need to sign on the tax audit minute and send back to the tax authority. In that case, you could submit the complaint separately from the tax audit minute to the tax authority in charge. For example, you have been tax audited by the Hanoi Tax Authority. You submit the complaint directly to Hanoi Tax Authority. You should not submit to the higher level, which means the General Department of Taxation. And you submit the complaint to Hanoi Tax Authority within 19 days of the issuing date of the decision. And the Hanoi Tax Authority need to handle your complaint within 55 days. And in case you still disagree with that opinion, and based on the result of handling by Hanoi Tax Authority, you could submit to higher level, which means the General Department Taxation. Submitting procedure. Actually, this procedure we call after you want to go to the higher level of General Department of Taxation, we call that procedure is tax appeal. And this procedure, there's no deadline for that procedures. So how could you well prepare for tax audit? This will be the procedures. So we need to prepare before the tax auditor come, right? The first, you need to have the comprehensive tax review every year. Your internal auditor or your accounting, your chief accountant need to review your tax procedures. And of course, many of our clients request professional like us to perform the tax review or tax health check in advance. It's kind of sample, a test for your company to see any tax risk and every year, and you could rectify the document by annually, and it will minimize the risk in the future. After review, you see some adjustment need to be made, and you will consider whether it's necessary to make the adjustment or let it to the tax authority come to adjust. Of course, we need to it's a tip that you need to leave some small amount to adjustment by tax authority. And of course, you need to supplement on document and preparation for explanation of some area which the risks, but you could properly explain for that. So that's the preparation before the tax audit. During the tax audit, you need to be sure that you need to regular communicate with the tax auditor to see any issue they find out, and try to find the explanation, supporting document to explain to them. And of course, you need to solve the issue by the conversation with the tax auditor of that tax audit first. You should not go directly complain, writing the appeal letter to the tax authority in charge. You should discuss with the tax auditor first how to solve the difference in understanding the law between two parties. And in case after you explain so many times on your opinion and they insist on the tax authority did not refuse to hear from you, we need to discuss with them that we will bring this matter to the next step, which means that we start the appeal step, and we will informing them how to solve this problem in the next step. And by the completion, we will consider the proposed by tax auditor and give your opinion in the minute, clear opinion in the minute, and of course need to sign the minute. And even you do not agree with the opinion of the tax authority, you still need to pay additional tax and penalty to the state budget first, according to the decision by tax authority. In case you successful in appeal to higher level, you could get it back, or you could deduct it, offset it with the future tax obligation. So remember that even you do not agree, still need to pay the additional tax amount. This how we could support you, because we think that well prepared is the key to success in the tax audit. So we could support you with perform the tax review to identify the tax risk, and we recommend the improvement and strategy. We could support in pre-audits and during the tax audit, and of course the post tax audit. We could support in preparation, obtain the ruling from tax authority, and assist in tax appeal. Yeah, that's what we could support you. And we hope that my presentation is beneficial with you all. And if you have any question or need more support, please contact us with the information in the screen. Yeah, thank you all.
Okay, thank you, Jing'en, for the presentation, and hello everyone. I will start my presentation with my slide. So give me 1 minute to share the slide with you. Okay, so thank you everyone for being here with us today. So first of all, I would like to thank ICHAM for organizing a very important event and very helpful. I'm Hobbizung Tash and Transfer Pricing Director of Brand Thornton. I have more than 10 years experience in this tax and consulting in Vietnam. So I would like to go into the idea that we cover today. So today we will cover 3 key areas. The first is the transfer pricing regulation overview in Vietnam. The second is about the technical key matters, and the third one is about the transfer pricing audit trend. So you know that for the last 10 years, I think the term transfer pricing is rising and is getting more aggressively dealt by the tax authority due to the issue of the state budget recollection. So I hope that the content today will be helpful for you. So the first point I would like to cover is the Vietnamese transfer pricing regime. So we go back a little bit, a few years ago. So I think if you guys follow clearly the development of the transfer pricing regulation in Vietnam, the 2019 is the 2017 is quite important year, which is the cutoff time. You know, in 2017. The most important regulation was issued, which is Decree 20. So we can separate that regulation development by 2 periods, before and after 2017. You know that before 2017, the transfer pricing regulation was only at the circular level, which means the only guidance of the Ministry of Finance. We did see the transfer pricing really taking place. I mean, the trend in transfer pricing really start by aggressive transfer pricing audits back in 2013 and 2014. And after that, since the transfer pricing is getting more important, when the tax authority and the government see the importance and the significance of the state budget from transfer pricing, so the government has issued the Decree 20 for the first time, the transfer pricing regulation at the decree level. So you can see the rising attention from the government on this topic. So I think the first decree was also a very strong basis based on the BEPS initiative of OECD. If you look for the BEPS definition, it was the base erosion profit shifting. This was an idea of OECD country, but applied generally, I think, globally. And Vietnam was very active in joining the community of the country using such guidance. And if you may know, the Vietnam was also the 100 member of BEPS community. In the Decree 20, and after that, the latest Decree 132 issued later in 2020, they provide a very updated compliance requirement following the international practice that leads to the requirement, including the local file master file that we discuss later on. Okay. We also have the Decree 1668, and this was about the EBITDA cap interest expense that we also discussed in the following slide. So as I said, the new regulation bring along the new regulation requirement on filing. So we also discussed the filing requirement. So as we discussed in the earlier slide, by 2017, the new regulation, the new decree came, and it separated the development of transfer pricing by 2 periods. Before that, under the circular 66 in 2010, the only regulation, the only documentation that require is the transfer pricing report and the disclosure form that at that time, which is the form 03. But from 2017, as you may know, that the regulation changed and they add several compliance report to the requirement, which is the master file CBCR. CBCR means country by country reporting. Anyway, in practice, during the tax audit, during the transfer pricing audit, based on our practical observation, local tax authority seems to focus only on mainly on the local file and the declaration form. It seems that there are less attention on the master file and CBCR. But actually, master file from our point of view is still an important document, since it provides a very broad image of the group activity in Vietnam. And we still see, even this is not popular, but we also see the challenge from the local tax authority on the master file, because if you don't have the master file, the tax authority can challenge the compliance of the whole transfer pricing dossier. And you may know that in some circumstance, the master file also provide the master file also provide the big picture of the group activity, including the M&A. For example, the M&A at the group level, somehow it can relate to the tax matter in Vietnam. For example, the licensing work or the withholding tax on the capital transfer, for example. So I recommend that the master files to be obtained and reviewed carefully in Vietnam. One of the change in Decree 132 is a new guidance on the CBCR that you can see in the next slide. The CBCR were actually mentioned for the first time in Decree 20 already, but in Decree 132, it takes into account the development in the regulation and the development in the transfer pricing practice in Vietnam. Since 2017, Vietnamese government has signed off certain international agreements, so they leverage the new development into the new Decree 132. Specifically, the regulation on the ultimate parent company, which is based locally, is still similar. The local parent company with consolidated revenue over 18,000 billion will have to file the master file in Vietnam. And anyway, this case is quite rare, so we don't really touch this. The other case is about, which is most of the case that we deal with, is a company doing business in Vietnam but have the foreign ultimate parent company. So there are a certain circumstance relating to this subject. The first is like the foreign owned companies with overseas ultimate parent company is not required to file CBCR with the Vietnamese tax authority through if such document is provided through the automatic exchange of information. Anyway, this scheme, as far as we understand, is currently not active. We heard that the tax authorities sign off and join some global forum on this, but still not officially signed for such kind of the exchange information officially. So for now, as far as we understand, this is still not available. So the only channel is between the company in Vietnam and the tax authority directly. The other case is that, which is also an unclear case, where the company in Vietnam having the group company overseas, and the parent company also have the CBCR filing overseas. But under the current regulation, specifically in the Decree 132, it was mentioned that the ultimate parent company country has a tax treaty with Vietnam, but has not signed a multilateral authority agreement with Vietnam. Is also request to submit the CBCR. Anyway, this is not clear on the deadline and the further detail on such submission. So we discussed, we had some observation and some unofficial discussion with the tax authority, and there are some kind of the opinion that the tax authority may want to receive it from the companies, but they do not provide yet any official ruling for this topic. And from now, we do see there are two approach for this matter. Some company they select to submit within the 12 months deadline, similar to the local parent company. But the other approach that we also are more of the view is more conservative approach, that due to the confidentiality of the document, and I think personally, I think this is quite a sensitive document, which provide a very broad information of the group. So it should be very carefully if you are considering the submission. So in this regard, we are more of the view that the company in this situation should have at least the CBCR keep in Vietnam, and upon the very specific request from tax authority, you can submit that later on. This should be discussed internally carefully. The other way is some company having the ultimate parent company overseas, but the parent company, which is a small group, small company, is not required to file the CBCR in other country in the overseas. I think because we understand that all over the world, the CBCR regulation, the countries provide some threshold on this. It means that not every company is having a group, a worldwide group, has to file a CBCR. Just some big company, for example, in Japan, as I understand, the threshold for the company to file the master file and the CBCR is 100 billion Japan yen. So this case, the decree 132 is also not very clear on this submission, because it said specifically that just follow the tax treaty, but actually there's no clear guidance on the CBCR submission on any international tax treaty that Vietnam have signed so far. So from our point of view, if the parent company is not required to file the CBCR in overseas, so may not be required in Vietnam too. But this is just the practical understanding. We have not seen any confirmation from tax authority for that. But please note one issue about this, that even the parent company overseas is not required to file the CBCR, but they still have to do the master file in Vietnam. That's different point of view. So please be note of this, and not to prepare the master file even in case the CBCR is not filed overseas. So I would like to go to some highlights in the new decree 132, which is the latest decree in the transfer pricing regulation that was issued later last year, by end of last year, and taking into account from the year 2020. So in the decree 132, the first change is to expand the definition of the related party in some transaction with individual, like the capital transfer or the loan. For example, the loan with executive individual which amount at least 10% of the charter capital. As you may know that under the current transfer pricing regulation, the transaction between the company and individual is somehow not clearly mentioned as the real party transaction. There is no specific provision, there's no specific clause on the decree 20 or decree 132 about such transaction. If you see the article on the definition of real party on decree 132 or decree 20, they are all the transaction between enterprise and enterprise. So, but we still see in practice that Hanoi Tax and Ho Chi Minh Tax Authority, they still confirm by tax ruling that the transaction between the company and its executive individual is still a real party transaction. So the company should be careful about this to determine whether it has the real party transaction or not. And one more thing is about the loan transaction. I think loan transaction is now having a lot of layers in terms of compliance in Vietnam. As you know that under the corporate tax regulation, there are certain layers on the interest expense, like 150% of the rate, right? And other interest expense. And also for transfer pricing, we already have the EBITDA cap, and now we also consider this kind of loan with the individual executive is a real party transaction. So the loan transaction is receiving much attention from the tax authority. So talking about the loan transaction, sorry. So talking about the loan transaction, back into decree 68 in 2020, we remember that at that time there was lots of arguments from enterprise community about the application of the EBITDA cap at that time, which was the 20% of the EBITDA cap. This was low, and due to lots of the arguments and lots of consideration from the government level, the government has issued the change in this policy. Actually, from our point of view, this kind of regulation is quite not a very transfer pricing regulation, since it touch also not just the loan from the real party, but also the loan from independent party. So it kind of a mixed policy between the transfer pricing and the thin capitalization. And that's why this raised lots of the arguments from the social media, so from the enterprise community. So actually the regulation under the EBITDA cap was mentioned in the decree 68, and then was also mentioned quite similarly in the decree 132, which is the change from 20% of the EBITDA cap to the 30% of the net EBITDA cap. So what is the net of the EBITDA cap? The net EBITDA is different from the EBITDA under previous regulation. Is that the net EBITDA also include the interest income from the company. So it is fairer, it is better for the company to apply the tax treatment. And another favorable tax treatment is that the tax non-deductible interest expense is also allowed to carry forward in maximum 5 years. So this quite similar to the loss carry forward. But there's still some uncertain, there's still some unclear point. When we look into the draft decree of the decree 68, we saw that there was a case discussed there, which is when the EBITDA cap is smaller, is negative, and the company get lost. But then in the final version of the decree, we didn't see it. And there's one unclear point happen when the company have the loss. So the EBITDA, for example, is negative. So the point is, what kind of the interest expense is non-deductible? This is the whole amount of the interest expense or the net interest expense, which means the interest expense minus the interest income. Since this is still uncertain, the company, in case of applying this regulation, can ask the tax authority for application. But from prudent point of view, our view is more that the whole interest income is non-deductible in this case. So the company should take this review carefully before applying. Another important and significant point that is changed under the Decree 132 is the Decree 132 has narrowed the arm's length range for the comparability analysis, which means that previously the transfer pricing regulation used the interquartile range, which means the range from 25th percentile to the 75th percentile. It is a bigger range, but by Decree 132, the range is narrow from 35th percentile to the 75th percentile. So the change from 25th percentile to 35th percentile seems to be small, but actually when we apply the calculation to our client, we see a big change in terms of the profit margin. So that's why that leads to the consideration that the company should look into the impact to its own profit, and to update and to renew the transfer pricing planning policy, or to make a transfer pricing adjustment if necessary. I think that this kind of the change was follow some other country practice. As we study, I understand that some countries such as India, they also apply to 35th percentile. So some company may not be impacted, for example, with high profit, but some company with already low margin, for example, under median, can be impacted by this. So please review your pricing policy if it is impact, and make the change if necessary. Another change which is important that we found in the Decree 132 is the definition of a commercial database. I think the regulation is getting seems to be more relaxed on the definition of a commercial database, but practically using the commercial database in Vietnam is still very sensitive. By the wording of the Decree 132, we do see that the document was removed from using the word publicly available source. So basically, if we only based on the wording, it seems that the tax authority tend to allow for the private company for comparison. It means that we can use a comparable as the private company. But based on our practical experience and our observation, we are not really of that opinion. And we think that the comparability analysis, the comparability review by the tax authority will still be very hard, and even getting harder. So it seems that this kind of the, let's say, the more relaxed on using the commercial database, even it is for purpose, for benefit of the tax authority rather than the benefit of the taxpayer. So we should be careful if we applying or we using the database of the private companies. We know that in reality, lots of companies still using is still making the transfer pricing report, the local file, using the private company or even the local private company. So the source of data is unreliable, and this is very risky for the transfer pricing audit later on. We deal with lots of the transfer pricing so far, transfer pricing audit so far, and we experience lots of the very hard challenge on the comparability and the source of data. So that's why we are more of the view, and we also highly recommend the company, if you have to prepare the local file, you please use the listed comparables. This is is safer for the company, especially during the transfer pricing audit later on. And the country by country report that we discussed already above. Okay, so that was the very basic overview of transfer pricing regulation, the transfer pricing environment in Vietnam. And I would like to move to the part 2 of my presentation on some of the key transfer pricing matters for the FDI company in Vietnam. So the first point that I would like you to pay attention to is the internal transaction, internal data. So when dealing with transfer pricing matters, we tend to think about the external comparison, which is using the database, and we compare with the external price, external profit. But please note that the current regulation, it prioritizes the internal comparison. And in certain situation, for example, in the internal comparison is even more favorable for the company than using the external comparison. So there may be potential price comparison. For example, you sell the same products to both independent and related parties, or you can purchase the same material from both independent suppliers and related party. So in that case, there may be potential price comparison and even profit comparison if there's some business segments. So please look into the company business model to look for this kind of internal data. But when using the internal data, there will be lots of adjustment that needs to be made because this is the internal data. So the tax authority may assume that you have more information. It's different, like different from the external source of data where you don't have lots of information. So if the comparison is made internally, so tax authority may expect we made all the different adjustments in terms of, for example, contract terms, in terms of the business condition, like the transportation cost, for example. So all of that adjustment need to be made to make the internal data comparison more reliable. Some other transaction which is normally that tax authority pay attention to is intra-group services. You can see it like the management fee or the share service charges or some technical support or something like that. Tax authority is paying more and more attention on this kind of transaction. They can see some indicators of the unreasonable transactions, such as the fixed fee nature, why the service is provided, or they can challenge on the allocation basis, the pool of costs, and they can challenge on the real benefit that the company entitled, or what is the supporting documents that the company have to prove the real service is rendered. So in this situation, normally the tax authority can concern on the who is the service provider. So we need to be careful, and we need to be aware of the potential challenge that the tax authority can put on the service provider, which means the related party. Some company can receive the service from, for example, a company in, for example, tax haven. So that can be a challenge. So we also need to pay attention to who provide the service to us. Is that entity having the same business with us? Is that company having a clear obligation and responsibility in the contract with us as a normal independent supplier? We also need to be careful if we pay the service fee to the companies located in the non-corporate tax country. We had deal with one case in where the supplier was with a party transaction based in Arabian company, and there seems to be no tax, no corporate tax there. So we should be very careful with that kind of transaction. And another consideration is about the benefit, which means what we really get from paying for that kind of service, or is it duplicated with others already available service. For example, some company already have the division, the people in some division like HR or finance, accounting, but they still pay the share cost to the group for the same scope of work. So this can be challenged by the tax authority. So the next transaction is about the royalty fee, or the intangible. It can be the royalty fees or the trademark fee. This is a payment that the company in Vietnam paid for the purpose of using the value from the intangible assets from the group. For example, the royalty for know-how, royalty for patent, for royalty for some technical information that the entity in Vietnam utilize from the group, or the trademark for product sell under the trademark of the group. So there's some consideration that the tax authority put during the transfer pricing audit, that, for example, the enterprise cannot evidence the real benefit from the technology transfer from the royalty. Some company, they just pay, and even, for example, the tax and accounting division, they are not aware about the real value of that. That is should be noted from the tax purpose, because this is a connection between the different division in the enterprise. So maybe they have benefits, but tax division, accounting division is not aware. So we need to check with the technical division for any kind of the benefit that the manufacturing activities of Vietnam entity is enjoying from using such royalty. And the other challenge, the other difficulty is about the supporting documents, because in fact, in reality, not so many companies in Vietnam retain sufficient supporting documents to prove this reality, because normally the royalty, if there is a real royalty, it normally happen in the working level. It happen in the manufacturing side. So normally the accounting division, they don't keep all the necessary information and supporting document, like the contract, the report, or the timesheet, and technical information, technical drawings, or something like that, because they just think that the contract is enough. But please note that we need to prove the real benefit of the contract. So the contract itself is not sufficient. You can see that practice just 1 or 2 A4 page of contract for this kind of royalty. sometimes it's very high value, but just 1 or 2 page contract. This is very not reasonable, and we need to retain and collect more supporting documents to support for that. Another issue is the royalty rate. So this is normally challenged by the tax authority. They can challenge that, okay, 3, 4, 5% is high. So there's some approach here. We also support our clients. Some of our clients, they ask for the benchmarking of the royalty. For example, we can benchmark from the independent contract that is 3%, 4%, 5% is high or is low, based on the arm's length, based on the market price that we collect from the commercial database. We do have a separate database for that, but this also needs to be discussed with tax authority during the transfer pricing audit, whether it is high or not, regardless you have that kind of benchmarking or not. So in reality, we still see that tax authority challenge this, and but their view on this is not consistent. It's different between tax team. So what we need to do, I think, is to secure ourselves for having a separate benchmarking for this kind of transaction. So another compliance issue of the royalty of the intangible is about some admin procedure in Vietnam. Specifically, it is the registration of the technology transfer agreement. There's a law on this, and the subject of technology transfer from overseas to Vietnam must be registered with the authority in Vietnam from 1st July 2018. So if you sign the technology transfer long time ago, you can continue that, but please refer to this law. Please refer to this law to see whether your contract is consistent with the law. If not, I recommend the parties to sign again and register that contract with the authority to strengthen the compliance status of this expense. We should pay more attention to this, since we do see the more aggressive trend in challenging this kind of expense. Also, the similar note for trademark, because if you have the transfer trademark from a group company, please ensure it is registered in Vietnam. Otherwise, tax authority can challenge the expense. The third transaction that I want to discuss is about the financial transaction. Recently, we observed a rising challenge in local tax authority about the loan from commercial bank in Vietnam, which qualify the amount over 25% of equity and exceed 50% of the total medium and long-term debts of a company. So that bank is also considered a related party. It has not been confirmed yet by some high-level ruling, but we do see the challenge in reality. Actually, if the company have other related party transaction, so it is not this issue is not important, because you already have related party transaction. But if the company does not have any related party transaction, so this transaction, even at the dispute situation, can raise a risk of applying the EBITDA cap to the interest expense. So we need to be very careful dealing with this issue. So until now, we see that it seems that the tax authority is not firm on applying the tax treatment on this. So we will keep following up to see if there's any new development. But if the company fall into this situation, so please be careful and need to think further on how to deal with this. We need to document, do we need to apply the EBITDA cap, something like that. Every consideration need to be careful. And as I said, now the loan transaction is getting more attention from the tax authority. For example, the case like interest rate 0. But in reality, we see less challenge. They don't really apply the tax rate to collect more tax. But maybe in the future, this can be a more important area. So that was about the first two sections, and I would like to go to the last section of the presentation about the transfer pricing audit. I think Ms. Ngân already provide some index, some data about tax audit results. So I would like to only focus on the transfer pricing audit. So as you can see that the number of the companies subject to the transfer pricing audit is not very high, but compared to the amount of the tax recollection or the loss reduction or increase of taxable income, it is very high. So if we compare the number of the company being audited with the amount recollect from the companies, so I think that it is a reverse picture between the normal tax audit and the transfer pricing audit. So that's why I think that we should pay much more attention on the transfer pricing compliance, especially after the COVID, because now you may see that in the first half of 2021, the tax authority can only go for transfer pricing audit for few first month, and from May we experienced very terrible lockdown, and as my observation, none of the our client can be transfer pricing audit during that time. So I think all of that transfer pricing audit is accumulated, and if we boom up after the quarantine, after the lockdown is removed, so the company should check if you are in the list of the transfer pricing audit by the authority. This list actually was released by the tax authority every year, so you can contact your tax official managing directly the company to see if we are in the list. And if we are in the list, we should prepare very carefully for the upcoming tax audit, because I believe that it will be harsh, it will be aggressive because of the low recollection from the beginning of the year. So in case we have the transfer pricing audit, so we should pay attention to certain area that I would like to discuss for now. One of the trends that we see recently is that back to a few years ago, tax authority tend to look at the profit of the whole company, but now things are getting changed, and tax authority now focus even more on the transaction, which means that if you are good profit, it doesn't guarantee that you are not adjusted by tax authority for, they can adjust for just few transactions, not on the whole company basis. So we need to review one by one to ensure the compliance. The first, we need to ensure that whether we have enough transfer pricing forms to be prepared correctly and to be submitted on time. And we need to be ensure that all the transfer pricing documentation, the master file, the local file, was prepared in place and ready to be discussed with the tax authority when they ask for the information. You know that you must know that in the law, in the decree 132, the missing of declaration form and transfer pricing report, local file, master file, will be deemed will be subject to the tax deem. It means that they can adjust the whole company profit if you don't have any report on transfer pricing. So this is a very serious issue. The second issue is about the loss situation of the company. If you doing business, you getting bigger and bigger in terms of capacity, but the situation is still in loss, and you have a big portion of the transaction with the party, so you are very high risk of transfer pricing. So in that case, the company needs to review its pricing policy, because somehow it may be the pricing policy is somehow not correct to lead to that loss situation, especially in the situation that the parent company getting high profit, the group get a very high profit. Another point is the business segment with low results. This happened in some case that you can see the whole company is doing good, but you have a separate segment for the related party transaction, so with the lower business profit. So still very careful in that situation, since the tax authority can look at that segment to adjust for the transfer pricing. And as we just discussed for the other transaction, like registration of the royalty contract, we need to fully comply under the regulation with all the transaction, not just the profit. And some transaction that the company incur with the country having low CIT rate or low the tax haven, that kind of service will be under risk. So please be careful with that. We need to prepare a supporting document and explanation on the real benefit of the service. So we have some recommendation for you to prepare for the transfer pricing audit in the future, for the transfer pricing compliance. The first attention should be paid to Form 01, which is a declaration form, because this is the first thing that the tax authority review, whether the value is correct, whether the method is matching between the local file and the declaration form, and whether the business result was accurately mentioned in the section 4 of the Form 01, and what is profit margin used in that form that should be leveraged from the local file. There's some situation that our client also dealing is the company only do the Form 01, they don't do the local file. So making Form 01 in that situation also need to be careful, because it need to be made in a way that later on when the local file is ready, so the information can be matched. For the local file, so please ensure the data used for the comparability analysis is in line with the regulation, and the TP method, the transfer pricing method, is also in line. And where the adjustment is required, is necessary, you should make the adjustment, the economic adjustment on the transfer pricing adjustment. During our tax audit experience, we see that for now, tax authority, most of the tax authority, tax office or tax audit team, they focus on comparability of the benchmarking a lot. So please have prepare for that challenge during the tax audit, the area that they potentially challenge, like the comparability indicator. So we need to be careful. And the last is about the compliance in terms of preparation of master file and CBCR. So this, I think we discussed quite well in the last slide. Please be prepared that other than Form 01, we also have Form 023. So this is the index of the master file and local file that needs to be submitted together with the Form 01 in the corporate tax finalization deadline. So please submit this fully submit this. So I think in the transfer pricing dossier, the most important document is still the local file. So the company should still pay lots of attention to this document. The first is the data. You should review the internal data, whether it is available, because if we only use external and when tax authority came to use the internal, the comparison result can be different and can be favorable or not favorable for you. The second is trying to prioritize the domestic comparable before we look for the overseas comparable. For the method, please cover all the method that's possible, not just the net margin method, but also the transactional method like CUP. We compare the price of the product. And please to ensure that the disclosure form is matched with the local file. And if there's any material difference in doing the comparability analysis, so we should put the adjustment for that during making the local file. Some of our notes during the benchmarking analysis, but I think this is more on the technical side, so I will go quickly for this. During the benchmarking with our experience, so the company should care about the size of the comparables, because if we have less comparables, the risk is higher when the tax authority can challenge few comparables, and if we don't have enough 5 comparables finally, so the risk, the whole set can be removed and is high. So we should have a quite a big size of the comparable set, and all other reliable of data should be taken into account. About the master file and country by country report, the first thing we should comply with the requirement in the Form 03. Form 03 provide the index of the content of the master file. So we should prepare all that information in place. Actually, this index is very matched with the OECD guidance. And the second thing is the consistency between the master file and the local file. The consistency between the master file and the local file, because if we prepare the master file and we provide, for example, the risk or the function profile of the entity, but it was mentioned differently in the master file, that will raise a question for the tax authority on the reliability of the transfer pricing dossier of the company. So we should check the accuracy and the consistency between these two documents. And the last thing is about the explanation, the potential challenge from the tax authority on, for example, in case we have the loss situation, for example, why the group having a good profit. So we need to take into account all other factors to see if that risk come from the real party transaction, or it's just based on come from the independent transaction. That needs to be explained under the master file and the local file, and we should look for the inconsistency between these two documents. And that was the notes on the preparation of the transfer pricing dossier. And at last, I would discuss a few typical transfer pricing case that we normally deal with during the work. The first case is the routine client, routine entities, but suffering unfavorable profit results. For example, the contract manufacturer or the limited risk distributor. So normally with this routine entity, where the function is very captive, very limited, but the company experience unfavorable profit result, that will raise lots of the question from the tax authority. So we need to put the concern, we need to consider how to benchmark how to benchmark this kind of the situation. And we need to consider, we need to define how much is a portion of the reader party. Is it all, or is it just a big part, or just a small part? We also need to look for the internal internal comparison data and some other technical matters like the true-up adjustment, or mostly for the limited risk distributor. This kind of the technical matters happen a lot in the transfer pricing transfer pricing audit case. And in case we cover all the approach, but we cannot find a better way to protect, to defend our transfer pricing case. So it's better to think about a voluntary transfer pricing adjustment, so we can avoid a significant admin penalty. And we also highly recommend in this situation the company may look back to the pricing policy, because a routine entity may or should not have a loss or continuous loss. So somehow the pricing policy should be reviewed. So the other transaction which is also typical is, as we discussed in the previous slide, is the royalty charge. So in this case, please look back and check with the parent company or the group company about the substance of this royalty charge. And we need to review the rate, whether it is high or not, or do we need to have a separate benchmarking for that, or do we need to reduce it? For example, some company may have a 5 or 6% charge of royalty. Based on our observation, that is pretty high. And we also need to review and reconcile the calculation to see whether the scope of the royalty contract is in line with the actual expense charged by the group company. Lots of the case, we see the inconsistency between the contract side and the actual calculation. This can, if happen, can bring a concern from the tax authority during the transfer pricing audit. And that basically our presentation today. And thank you for your attention. And if you have any questions, so we can discuss right after this. And if we need us for any kind of support in the future, we hope to receive your contact. So here's my contact for the transfer pricing work in Grand Thornton, and hope to work with you in the future soon. And thank you very much.
Yeah, thank you, Dũng. Thank you, Ngân, for your really wonderful and very useful presentation. Indeed, we received many questions regarding the presentation, because it's really helpful. Before we move to the Q&A part, I'd like to underline that both the presentation of our speaker today and also the recording of this webinar will be available very soon, within 2 days. The presentation will be sent directly to you via email, which is you leave to ICHAM via registration online. And the recording of the webinar will be available on our YouTube channel of ICHAM. So I know it's 5 p.m., but since we received many questions, if you can remain with us for the Q&A part, that would be much great. Let's move for the Q&A, and the first question is for Ms. Ngân. We have the first question from AstraZeneca. Do we need to have form number 4 or any certificate for the COVID expense to be deductible? Ms. Ngân?
Actually, I'm not quite sure the form 04 you mentioned in the question. I believe it's from 04 TD TDTN in the circular 17878, right? In this case, you do not need to get the form 04. The circular 78. We understand that the COVID expense mentioned here is quite a wide range of expense, in which we could classify into two types. The first one is the normal expense, which could be supported by a legitimate invoice, such as the quarantine expense, airfare, cost for testing of COVID. The further expense, sure, it should be supported by the invoice, non-cash payment voucher for amount more than 20 millions, and the labor contract if you pay for your employee or decision for ship in case the expense for this ship, kind of that. But in case the other case for the expense for COVID-19 is the sponsorship or donation for COVID expense. So according to the Decree 44/2021 NDCP, in case you make the donation for the COVID fund or vaccine fund, you should not use the form 04 of Circular 78, but you should get the written confirmation of sponsorship, which the form has been attached with Decree 44. And that form should be signed of both parties, the sponsor and the party who receive, the receiving party. And of course, it's supported by the payment vouchers or invoice in case you sponsor in kind, not in cash. Yeah, that's my answer.
Yeah, great. Thank you, Ngan. And the next one is for Mr. Dung. The question from Ms. Nguyễn Thị Vân Anh, CBCR and master file can be in English or it need to be translated into Vietnamese to be ready for tax requirement?
Yeah, so based on the tax law, admin law, so all the tax dossier with the tax authority must be in Vietnamese. So all of that document must be translated into Vietnamese. Yeah.
Yeah, thank you. Thank you. The next one is for Ms. Nguyen. Salary paid to staff who first time come to Vietnam but not yet get the work permit due to the COVID, still considered as a deductible expense. And the second part is support by cash to family, spouse, for example, of a staff who was died due to COVID-19 is subjected to personal income tax or not?
Yeah, there were two questions, right?
Yes.
So for the first one, as in my presentation, I have mentioned the official letter no 2099 issuing by Bargaining Authority. The Bargaining Authority permit the salary expense during the period without the work permit of the expatriate still could be treated as the deductible expense with the reason that the company could proving that the delaying in issuing the work permit is due to the authority. It means that you could prove with the tax authority that you already submit the application for work permit, but the labor authority refused or delaying in granting it. So in that case, the salary expense for expatriate during the period of not having the work permit still be treated as the deductible expense. Yeah, because as I mentioned in my presentation, in the early stage of COVID-19, there will be guidance by Molisa that they suspending, delaying issuing work permit for the expatriate who come from the country who got the COVID pandemic. That's why they renting this exception case. And the second question, you said that you pay support cash to families of staff who died due to COVID-19, whether this support is subject to VAT or not. Actually, this support could be considered as a further support. And according to the Circular 29 issuing in 2015 by MOF, this kind is considered as the welfare benefit for the employee, and but will not be treated as the taxable income. It will be exempted from VAT.
Yes, thank you, Mr. Dung. The next one is for you. the question from Perfective and Mele, how to identify the company need to submit the CBCR or not, because the regulation is not clear.
Yeah. So the first thing we need to consider is whether we are subject to transfer pricing regulation in Vietnam. There are some threshold, the safe harbor. If we are subject to transfer pricing, so we need to consider, as we discussed in the slides earlier, we need to consider whether the parent company is subject to CBCR overseas. If the parent subject to CBCR, so we should have at least the CBCR to be kept in our Vietnamese office, because now the submission requirement is not very clear, as I said in the slide. And if the parent company is not required to file the CBCR and master file overseas, so it seems to be that we are also not required to submit the CBCR in Vietnam. That is based on the latest Decree 132.
Yes, thank you, Dũng. Ms. Ngân, are the quarantine expense at hotel subject to 15% comparison?
Yeah, actually, this measure have been guided by tax author by highest level tax authority is the General Tax Department, and in that guidance, official letter no 5032, tax authority only informed that the hotel expense during the quarantine period will be included in the taxable income of the employee, so it will be taxable. The guidance of the guidance, but in that guidance, even not separately guide for PAT, but for the CAT section of the official letter no 5032 by GDT, they divide the expense for the employee during the quarantine in multiple types of expense, and in which the quarantine expense for hotel could be considered at the housing alone. That's the reason why after that guidance from GDT, there were many guidance from local tax authorities such as the Hải Phòng Tax Authority and Bắc Ninh Tax Authority and Hải Dương Tax Authority. They informing that the company could use include that expense into the housing allowance. So this housing allowance will subject to the cap of 50% of total income, not including the housing allowance.
Thank you, Ms. Ngân.
Yeah.
The next one is to Mr. Dũng. Does the tax authority recognize the OECD guideline?
I think for now the tax authority only based on the transfer pricing regulation locally, which is the Decree 132. Basically, this guidance, this decree was also based on the OECD guidance, and we can refer just in the case that the law in Vietnam is not clear. We can apply in case the law say differently, so we can apply OECD in that case. And another note is that applying the OECD guidance should be, from my own experience, should be very limited, because the tax authority in Vietnam, they do not prefer to study or to refer to such kind of document. They are not maybe comfortable using this kind of guidance, so try to limit that use.
Yeah, thank you. Ms. Ngân, with the regarding to the fund from reduction 0.5% contribution to social fund, will be okay in case company does not use it? Does company have to report the usage or any authority?
Yeah, actually, in practice, you do not have to report the usage to any authority. In the concept, I understand that now the usage of this fund will be audited later on by the relevant authorities, such as the Social Insurance Authority, when they perform audit at your company. At this moment, we understand you do not have to report to any authority on the usage of this fund. So that's the first point. The second point is you do not intend to use this fund, right? By law, you could not contribute this fund to the authority, and you should use this fund to directly support your staff to help them to prevent the COVID-19 pandemic. So there will be two options. I think you could use. The first one is you payment in cash to them. That portion of 0.5% you pay along with salary. That's done. The second option is you pay it in kind, which means you pay for purchasing mask for staff and sanitizer, or provide other support like protection gear or COVID testing expense for them. So that also considered as a direct support to your employee. So in our understanding, that the only way to use this fund, and since you could not contribute it to the authority, and of course you should reserve the supporting document to prove the usage of this fund to submit to the authority later on when they perform the audit at your site.
Yeah, thank you. Mr. Dũng, the question for you is, the related party give loan to company with interest rate 0%. So the government can collect more tax. Why this transaction is subject to tax assessment? And the second part is, what will the tax auditor audit will with management fee?
Okay, so the first point is about the loan, because not just about the transfer pricing regulation, even the tax admin law also have a clause on the market price of any transaction, not just real party transaction. So basically, giving a loan at 0% is not a market range. So technically or theoretically, it is subject to the tax review, and the tax authority has a right to adjust it to the price that they think is reasonable. And the second question, sorry, Hai, can you repeat the second question?
Yes, what will the tax auditor audit with management fee?
Yeah, the management fee, as I said in the slide, there's certain factors that we need to look through, like the benefit or about the supplier, the nature of the supplier, or there's any duplication, and what is a supporting document. Lots of things that need to be considered during the review of the management fee. So basically, that is also the challenge from tax authority on the management fee. So we need to be prepared for all of that explanation and preparation of the supporting document to prove and to defend our expense to the tax authority.
Yes, thank you. Ms. Nguyen, how can we check by ourselves whether we are high or low risk, and will be focused by the tax department?
Yeah, actually, the tax authority has a separate system called TTR. It's the tax risk rating system of the tax authority. And the tax, each of the tax code will be managed by each of the tax authority in charge, and they will rating that system based on the information collection from the employee. So that database is belong to the tax authority, and we could not access it. But of course, you could know about the concept, how the tax authority could rate you at the high or low. You could refer to Circular 31 issued this year, 2021, by MOF. And in this circular, there will be clear guidance on which criteria the tax authority will use to rate you as a high or low or medium rate. And you could refer in that criteria and see how they could rate you at the high or low.
Yeah. Since it's already 5:26, so I give the last question to Mr. Dũng. Our company gross margin is very close to the 35th percentile of the chosen comparable. Can you please let us know what we should do to mitigate tax risk in the future tax audit?
Yeah, so I think we discussed this also matter in our slide. And the first point I think I need to correct your understanding is about the gross margin. I'm not sure whether you use the gross margin comparison or this is a net margin comparison. So please be unsure about that. If we compare the gross margin, so we need to use the gross margin comparison. If we use the net margin, so we need to compare the net margin. Second thing is about the range. So if I think that situation we also discussed in the slide and very typical impact by the decree 132, and we need to review. The first thing is the benchmarking methodology, whether we are applying a little bit too high or every adjustment that we can make to the company. For example, we can have some economic adjustment to the comparables, or we can make adjustment something like working capital adjustment to make because normally the real party in Vietnam, it is the more likely a routine entity. So the working capital is normally more efficient than the comparable because comparable are independent companies, so they don't have a good situation like a real party transaction. So normally we have a better working capital situation, and so that in that case we can have kind of economic adjustment in terms of working capital and some other technical skill. But I think this question is a very can have a very broad answer, and if you need any support, you can contact us. Technically, I give some general answer like that.
Yeah, thank you very much, both Dũng and Ngân, for your wonderful time explanation and introduction about this topic. And we already our webinar is supposed to finish 1 hour ago, but since the topic is very hot and the attention of the participants of the audience is very high, and here we are. So before we finish our webinar, I would like to repeat that all the presentation of our two speakers today will be sent to you directly via email, and the video recording will be available on our YouTube channel, ICHAM, within the next 48 hours. And again, if any question that your question are not answered, our speaker will reply to you directly via email. Because our speakers already have on the list of your question and your contact point. So thank you very much for joining our webinar. A big thank to our wonderful speaker today. And I'm very looking forward to see you in our next event of ICHAM. I'll give the floor to Mr. Dũng and Ms. Ngân to say a few words also to say bye to our audience, please.
Yeah. Thank you for your attention, and if you have any question, please contact us.
Thank you, Anh Hải, for your very great words and a very great support. Thank you, ICHAM, for making a successful event, and thank you everyone for taking your time. Yeah.
Thank you everybody, and have a nice evening.
Yeah.
Thank you. Bye bye.
Bye bye.